Hi and welcome to the Market Alert for Thursday, the 23rd of March 2023. There's a lot to get through this morning, so let's get on with it. Yesterday, UK CPI came out at 10.4%. Apparently it was a surprise. Well, anybody that follows the Market Alert will know that it's no surprise whatsoever. This is going to continue with the odd ebbing and flowing, but it's going to continue on the upside, particularly with the money printing that's going on in the US at the moment. One thing that is very interesting is the RPI, which has been downgraded to a low impact news item. This came out at 13.8%, and of those of you that are old enough to remember, and unfortunately I now count myself in that category, that remember the RPI. It never used to be the CPI, it was the RPI, and that is 13.8, and we all know that that is also greatly downplayed, as we know that it's a lot higher than this, but that also coming out. But it's amazing, isn't it, how the smoke and mirrors of the Treasury and the government to hide these things. So we'll just downgrade it to a low impact news item. So you can see there 13.8 for the RPI as well. And also, of course, that affects today. Bank of England set to raise rates for the 11th time in 18 months after the inflation shock and surprise, as it went up to 10.4% in February. Okay, over to the US. The Fed hikes 25 basis points, maintains QT, removes hawkish guidance that he commented on in the front of the Select Committee in February. I think it was February, it may have been the beginning of March. Anyway, some additional policy firming may be appropriate. So more tools is what it means. It's a euphemism for we'll create whatever we need to create, give it a name, and then continue to bail out. Yellen pulls rug from Powell's dovish promises. Gold gains as banks bust. Damn it, Janet. That's obviously cited at Powell. Stocks down in wake of Fed banking crisis still in focus. Yeah, absolutely. It's not over by a long shot. US stocks declined in aftermath of FOMC and Yellen's testimony. And of course, what you've got to remember, even though it's a quarter of a basis point for the rate increase, that's going to affect the balance sheet of the banks. So it's not over by a long shot. This is also interesting as well. Interest payments on Treasury debt up 29% year on year. It will be because they've continued to raise rates, and that's what a lot of people don't realise, is that when they issued all of the QE money, it was at low rates, and of course the interest payments on those bonds is going up because they've gone from more or less 0 to 4.75 on the long dated 30 years. So yeah, and then of course, as I've said, and I'm going to say it again, it makes you wonder whether this is engineered with all of the banking collapses of these regional banks. Well, it was intended, because I cannot for the life of me understand why people like Powell, Yellen, etc., unless they're complete and utter morons, couldn't actually foresee that by creating rules for banks to actually buy a percentage of their reserves in long-dated treasuries with low rates, and then when they go up, the impact it would have on the devaluation, hence unrealised losses. So surely, like I say, they were aware of this. But what's interesting, of course, is that this is the perfect vehicle, or not vehicle, the perfect storm to bring in the perfect vehicle for the governments, and that is the CBDC. Governments will probably mandate CBDCs as the solution when the next real or contrived crisis hits. Well, the contrived crisis is what I've just mentioned. Surely they must have known, which is likely not far off. I don't know how far advanced they are with the CBDCs, but yesterday I had a debate with a friend about this, and he said people wouldn't be so gullible as to take it. Well, let me play devil's advocate again, because for me it's quite simple. If we could think back to the SVB a week ago on Sunday, when some people had 10 million, 100 million on deposit with the bank, and they were only going to end up with $250,000, and the government said, well, actually, we can guarantee the full deposit by moving you into the new system, the CBDC. Well, how many people are going to actually balk at that and actually reject it and say, well, actually, I don't want the infringement of privacy and the removement of liberty. So, I'll go with that. I'd rather keep my 10 million and be monitored. So it's going to be a piece of cake to bring it in. You create a systemic banking crisis. We've got the start of that. And then it's easy just to roll everybody over. Whether you get the money or not is a different matter. There's a brilliant interview with Monaco64 and Clive Thompson, which I've mentioned before, about the implementation. A former Swiss banker who talks about that they'll promise the money, but you may never get it because it's in the old system. So interesting times ahead. But yeah, I've said this for a long time. The only way you can bring in something like this, which, like I say, removes people's privacy and liberties, is you create something where they have more to lose, and we'll take that option. We saw it with COVID. Okay, let's move on, have a look at the markets. We'll kick off with the Dow, see the reaction to the Fed's increase of 25 basis points during yesterday evening. So in the daily of the Dow, we can see the market's reaction. It wasn't impressed whatsoever with prices moving lower, but that said, overnight the markets found some support at the 50% retracement, which we can see there, or just above it. Also finding support there yesterday. So let's look at this in a bit more detail. And you can see yesterday the market fairly sideways, then up, and then the market's reaction to the testimony from both Powell and Yellen, and the market then moving back up at the moment. Depends how far it can move and what's coming down the line next, because I know there's another bank that's already starting to talk about problems. I can't remember the name, but it was on zero hedge. It's a matter really of whether the market holds or we go down and test these levels in the daily chart. So we'll have to just take it as it comes when the markets actually open. Just have a look at the range for yesterday from high to low as well. 754 points down on the Dow at 1 point before the market actually recovered. Just as an aside as well, let's just have a look at the average range for the Dow over the last few weeks. 581 points per day. So yeah, it gives you a pretty good idea of the level of volatility there. Implied volatility kicked up with this last night, 782 up from 1653. So obviously the options traders slightly alarmed about the fact that it's 25 basis points. They may get away with that and the market can move higher, but at the moment they're sort of thinking, well, hang on a minute, it's still going to affect the balance sheet of the regional banks because we've just increased by another 25 basis points there. And in the German DAX, this also down, but making good progress on the upside at the moment in the overnight market. Futures opening at 7, 25 minutes to 7 at the moment as I'm recording. Just above the 50 EMA there. We've got a bit of selling in there, but like I say, that seems to have been absorbed or disappeared. And as you can see there, making ground to the upside. Over 100 point move from last night's low already on the upside and above the DP at the moment. So a bit stronger than the Dow for sure. No surprise there. 62% retracement there. The market's got to hold above the DP in order to attack yesterday's high, which is another 100 points. And again, we'll look at the range of this market in just a moment. But let's have a look at yesterday, the market moving higher, coming back, trading back 89%, dropping down, then waiting for Powell. The market rallies and then sells off 200 plus points there. And like I say, overnight, already over 100 points. Let's go back to the daily chart. Let's have a look at the range of points for the last couple of weeks, and you'll see there is an average now of 302 points per day for the German DAX there. So you know when you're in a trade and which direction it's heading. If it's heading back for the high like it did yesterday, that it's got a lot in that direction. As can be seen there yesterday, just over 100 points on the upside. The market then coming back 100 and then back to the high as well. Always try and target the high, the close and the low once it breaks a DP level. So if you're above it, it'll try and target the high. If you're below it, try and target the low, and then you can work out the average points that you could expect in that trade. Trades for the week, not as spectacular as last week so far, 136.26. I came back on Monday lunchtime from a weekend away, made a complete dog's breakfast in the afternoon for whatever reason, was down on the trades, but not a problem. Managed to crawl back a bit yesterday, and then last night got it all back plus 136. So again, up on the week. It's the way it goes. 1.19 actually says it all in the profit factor. You want that above 2. 2.5 would be better. And here you can see that 51 against 49 winners. So losers to winners there against, but still making a profit because I will keep the losses tiny. If it isn't doing what I want it to do, I'll get out. I couldn't care if I have 9 successive losses. It doesn't matter. As actually, funny enough, it says that there. Couldn't care less because they're only a few quid. And then when it goes in my favour, I let it run, and then you'll see there that you can gather it all back. Same as last Friday as well, which, like I say, 3.5 grand last week. So who cares about a few losses that are small? It's a psychological thing and an emotional thing. And once you get used to being able to play the probability game, it's not a problem at all. You just keep those losses small, and when it goes, you then ride the wave. So you get in those 6 to 7 to 1 returns. Okay, let's move on and have a look at how the S&P and the FTSE fared during yesterday. So in the S&P 500, similar to the Dow, market back to the 200 MA, closed below it, but has managed to get above this overnight. And it's important that the market holds above here if it's to move higher and take out these targets on the upside. Failure to do that, you are looking at these sorts of levels on the downside to retest the low to the left there. 30-minute chart says it all. Market did absolutely nothing whilst waiting for Powell, and then you can see the reaction there, which we've already discussed in the Dow. And at the moment, 200 MA is giving the market a bit of grief there. It's just sitting above it though, and if it can get above the DP and the 50 EMA, then it'll be free to move up to the BRN and the R1, and then the high as well. Meanwhile, in the FTSE 100, very narrow range for yesterday. We've got the rate increase coming out at midday today, trading up to 50% retracement there, with a bit of selling coming into the market there, a bit of supply. In the 30-minute chart, this is how it looked yesterday. DP, which I've just mentioned, you've got the volume there, and then the market making its way up. Then we have a double top, and then down we came all the way back from where we started, and the market retracing around 50% of that loss at the moment. Yeah, just at that 50%. You get used to seeing the way the land lies, as it were, to work out the percentages without drawing them on the chart. So around 50% retracement there. Got to stay above the DP level there. Meanwhile, in the currencies, GBPJPY, that down yesterday. Let's have a look at the 30-minute chart of this. You can see we moved up nicely. We got our retracement, and then with a drop-off in momentum, and then the market down. Sat on the high. Again, once the market goes through a high, you drive through the high, and then the market will find support at these on the way back. Even if it trades below, they'll do whatever they can to try and bring it back, because if you've got an uptrend in place, you want to keep taking out the previous day's high to keep that going. So the high is very important. However, the market succumbed to the rate increase. The market dropped, went down to yesterday's low, and again, the market will bounce off the previous day's low. It's very important, and they move in the market back to the upside there. Meanwhile, in the pound, moving up yesterday through the 78% retracement, but closing back. However, overnight prices are trading above this level at the moment. 89 is the next upside target at 12375. Rate increases are good for the currency. That's out at midday today. And in the 30-minute chart, we were up, we were down, DP and close, very important levels. Market retraces 89%, moves up, comes back 62%, and then moves back to the high once it takes out the DP with buying. So you can see this pattern all the way through all of these charts. It just jumps off the page when you, or the screen in this case, when you get used to seeing it, and that's how you can trade the probabilities in the markets consistently. Right, quick look at the US dollar. We've been down for the last few days, 104 down to 101, certainly heading down to the sort of lows here at 100, 100.5. So yeah, no surprise really, and considering there was a rate increase last night, the dollar should have gone up, but it didn't, and that's because, unfortunately, they're starting to lose their credibility because they're actually trapped, aren't they? They're trying to bail the banks out and actually increase rates to combat inflation, and there it's shown there. And maybe the dollar was expecting 50 basis points, and it only got the 25 as well. So there's the market's reaction to this. And finally, in the metals, well, silver allowed to move up yesterday through the 62% retracement. If we can get to that 24, will be great, because that's where it sold off before. Market's still moving up quite strongly at the moment. However, with the momentum's dropping off slightly from a technical perspective, so we could see a bit of a correction if the dollar gets any strength. 30-minute chart was down to begin with, and then moved up, sat above the high, as I've mentioned before, then drives back through the high with the volume, and then to the 23 level, that's $23 an ounce here, the red line, through, and then push back to the DP where it's bounced off at the moment. You see a cluster of volume there as well, and now needs to take out the high of yesterday at $23.06, $23.06. The gold price has moved back, as we saw in the headlines. Nice reversal off the 1940, which was a 50% retracement, and moving up there, stuck 62 on the upside at the moment. So good recovery yesterday, and in the 30-minute chart you can see why. The market coming off the previous day's low comes back 89% and then makes its way through the close, drives through the previous day's close with increased volume, then trades sideways and consolidates with the 50 EMA and the 20 bar moving average. To get through the 200 MA and the DP, you need to drive through with high volume, and that's exactly what you get. This is followed through in the second bar, press conference, third bar, and then the market starts to settle. No one's taking profits, and overnight the market is traded up to the previous day's high. Needs to stay above this as support in order to move up to that 24, not 24, this is going to be back to the $2,000 range for the gold price. At the moment it's sitting at 1980 there. And finally, let's have a quick look at the gold-silver ratio. So gold-silver ratio moving down again yesterday as silver accelerated a lot faster than the price of gold. And overnight, though, a bit of a swap where we've seen this just move in gold's favour, moving a bit better percentage-wise than silver. Okay, well, that's a bit of a long one, but there was a lot to cover, so I will end now so we can get on with having a look at the markets. And as ever, thanks for watching. See you in the next one.